if you sell it, it's going to be a capital loss, but an income gain. So you could potentially be taxed on income that you no longer have the value of.
Good morning, everyone. Welcome to another episode of the Solve to Evolve podcast. We are doing this on a monthly basis now so that we can share our insights more regularly to the investors, the individual taxpayers, you, the business owners, about what's really going through or happening in the land of Australia. And so my name is Phil. I've got Bloxy and Jono. Gents, how are you this morning?
Good, thanks. Good.
Very well, never better.
Excellent. Love to hear it.
We're getting close to end of financial year. I thought we could talk about some year-end planning and how you approach that for your clients, Phil, and what people should be thinking about.
That's a very good question. At this point in time or this time of the year, what I would be advising to business owners is to review their goals from last year. How did they go over the last 12 months? Did they achieve what they set out initially? Were they able to hit those targets? And if not, did they fall short? And how short did they fall? Because that information there is going to be key for the next 12 months of planning. What I would first look at for the next 12 months is probably 4 non-financial goals that you would like to achieve. Those 4 goals I'll then prioritize over the next 12 months. And the way I would do that is each priority should be set in terms of, will be achieved in a quarterly timeline. And so over the next 4 quarters, prioritize each of those 4 goals over the next 4 quarters to see how or when you would like to achieve those goals. And these goals could be implementing new sales systems, sales processes, marketing strategies, investment into staff, assets. And ultimately, once you have those 4 goals in place, I will then look at what are the monthly projects or work items I would need to achieve that specific goal. And by the end of it, over the next 12 months, you should be able to achieve those 4 goals. I will then look at the financial budget or forecast over the next 12 months, look at the revenue, look at the expenses. The key consideration and assumptions at that point in time will give you a good or accurate reading at that point in time as to what the next 12 months will look like. And once you do that, I will then set KPIs to actually track that progress.
Yep.
For bigger businesses, I would ideally update that forecast every month or maybe every quarter, just because as the months go on, a lot of things do change in the business, and that can either positively or negatively affect your business, and you need to update the forecast accordingly to show the financial impact of your business. So if one of the financial goals was to achieve a 20% net profit and a major event happened 3 months down the track, it would be good to update the forecast for the next 12 months then to see if you are still on track to hit that financial goal of 20%, for example.
That sounds like a really good process for actually holding business owners to account to achieve what they set out to achieve at the start of the year, at the end of the year, and then looking forward as well.
Yeah, that's right. I think most businesses or business owners get into business and they will work really hard at what they're doing, but they're going to get to a point where they actually need some accountability, where you can keep working the way you are, but ultimately are you working harder than you were as an employee? Because ultimately you got into business because you want to be a business owner, get that work-life balance, live life. And so there will be a point in time where if they're not holding themselves accountable, they should reach out to someone else to hold themselves to account as to these are the things I want to work on to grow a sustainable and self-perpetuating business so that I can have that time to spend with my family or whatever it is you might want to do.
And it's you said it was both the non-financial goals and strategy and also looking at the numbers as well. So it's both of them talking to each other.
Yeah, that's right. I think you definitely have to do both. Financially, it's great, but when you look at the financials, the revenue, the expenses, the bottom line, you got to dig deeper, and that's where the non-financial things come into play. Because what are the screws that you need to turn in each section in order to get to where you need to be?
Yeah, 100%. Good one. What about you, Bloxy? What sort of planning are you thinking about this time of year?
This time of year, John, I typically would talk to clients who are wanting to understand how their personal financial life is progressing. And similar to Phil, like we'll want to document an updated group structure for the family group so that we can understand what has happened during the year. Have there been any asset purchases or sales? Have new liabilities been assumed? And then document that at a point in time. And if we've done this process the year before, which for many client family groups already have, so we'll then look back and say, okay, 1 year ago, this is where we were, and you wanted to achieve X, Y, and Z by 12 months hence. Then we can use that process to look back and, again, hold the controllers of the family group, who are often also the shareholders and working directors inside a business, a company or a trust operating structure, to account for how they have progressed their consolidated net asset balance over the previous 12 months. And that's insight that isn't often given because it's actually not required by law. So where you have BASs that need to be lodged or you have income tax returns that need to be done, financial statements are prepared and numbers are produced. But with individuals and family groups, personal financial control is often not as well understood. There are other things as well that are done, the standard things, looking at, for example, a high income employee. Are they going to be travelling next year? If so, can you push your bonus entitlement to 1 July? Are you a high income woman in a childbearing age? Are you family planning for next year? If you're going to be making less income next year, more income this year, can you push a bonus entitlement forward? Can you bring a deduction backwards? For example, prepayment of interest on an investment property. So those are the standard things that are done, but then the bigger picture thing is more about getting a handle on the family group's consolidated net asset position and then coaching them or teaching them how to be more tax efficient, and then documenting those numbers at year end, and then using that as a springboard to look forward, but also as a point of reflection to look backwards.
Yep. And you were going to mention super contributions as well?
So another specific thing that should be mentioned this year in particular, more so than previous years, is that way back when Morrison and Frydenberg came up with the idea of doing a 5-year carry forward for concessional super contributions that were unused in the current year. What that means is that if the concessional super contribution, say in 2019, was $25,000, if an employee only had $20,000 contributed into their super account, then there was $5,000 of concessional headroom that was not used for that year. Now, as from 1 July 2018, that headroom was able to be carried forward for up to 5 years.
Yeah.
But you don't count from 1 July 2018. You count from 30 June 2019.
5 years backwards.
Correct. So the first sunset is going to be on 1 July 2024. So from 30 June 2019 to 30 June 2020, 2021, 2022, 2023, 2024. Okay, so in this next 12-month period from the end of 30 June 23 to 30 June 24, it's very important that my clients are made aware of their carry forward headroom balance.
Yep.
Now it's a 5-0 situation, so first in, first out. So where clients make additional personal contributions and lodge what's called a notice of intent to claim with the trustee of their super fund or their super account holder.
Yep.
If they deduct an amount of money for personal concessional headroom, the earliest, the first one will be used up first.
Yep.
Okay, so it's very important that by the end of 30 June 2024, that the headroom for the year to 30 June 2019 is, if possible, completely consumed.
Yep.
Yeah, ideally speak to your accountant about that to make sure you are utilising the carry forward.
Yeah. So you're saying ideally look back what went in during 2019 into your super fund, see how much was left underneath that contribution cap.
Correct.
And then if you can, put that
Utilise
money
it.
in and claim the deduction.
Absolutely, because it's a use it or lose it situation, Jono.
Yep.
If you don't claim the deduction before 30 June 2024, you lose the right to claim that deduction for the personal concessional super contribution going forward.
Yeah, that's right. Yeah. All right,
Makes
that's a good
sense.
one. Thanks, Bloxy.
What about yourself, Jono? What would you be doing at year end for your clients?
Yeah, one big thing, or number one that I look at for, especially for companies, is to review your director loan balances from last year. So for tax purposes, we know that when you pull money out of a company, it's either salary and wage, or it's a dividend, or it's might be treated as a loan. So like I pull money out and I owe money back to Solve Accounting, but then a dividend is paid to clear that off at the end of the year. So review those balances, because you might have to pay out dividends. You might have to make a repayment on that loan if you're utilising what's called Division 7A, which is basically putting that loan on a commercial basis and paying it back over 7 years with interest. So you need to be wary of that to make sure that whole loan amount is not treated as a dividend to you, which is a bad tax outcome. Number two, I would also, for business owners, I would suggest doing an estimated tax calculation, maybe sometime in June. Make sure your books are reconciled up until the end of May. Then you can actually sit down and do some planning, some tax planning, look at some of the levers that you can pull with deferring income or bringing forward expenses or making super contributions, because ultimately the individuals are taxed. So having your numbers up to date and being able to estimate is going to reduce your stress, because you know what's coming next year when you lodge your tax returns, because it's always after the fact, and it's going to give you time to potentially implement some strategies.
Yeah, plan ahead.
Another thing that you mentioned earlier, Jono, was the end of temporary full expensing. Can you just touch on how that is important as we approach 30 June 2023?
Yeah, so that was talking about capital expenditure by businesses. So up until the end of June this year, there's no limit on that.
Right.
So no limit whatsoever. And it's available for companies or businesses up to 50 million turnover. So that was a very generous one that was put in place during COVID, when there was a lot of tax breaks and concession. And now we know from the budget next year it's going to be reduced to 20,000. So if you're spending more than that on your capital expenses, you might want to bring that forward for sure. Second one I also wanted to touch on was for anyone in crypto, anyone who's a crypto investor or holds crypto. I think the most important one is to review your portfolio before year end. If you've got a tax reporting calculator or
Hasn't been a good
Coinly,
year.
or it may not have been a good year, so you might be in a loss position this year. So you might want to look at whether you're in a gain or loss position, and if there's any coins or dross you don't want to hold anymore, just clear it off before the end of the year to realize that loss. Otherwise, it'll just be sitting there as an unrealized loss and you don't get any benefit for that. As long as you don't engage in what's called a wash trade. I'm not giving financial advice or telling anyone to do a wash trade before year end. Let's make that clear, which is basically where you sell something off and buy it back later on, to recognize a loss. Don't do that. Take advice if you need it. And also the other one for the crypto guys, a big risk is anyone who's involved in DeFi staking or similar activities where you get staking rewards out of a smart contract. You need to know that, similar to employee shares, you get taxed when you get the value. So you're assessed on whatever the value is at that date during the year, and then you're at risk. If the value of that coin drops after that point, you're on the hook. And if you sell it, it's going to be a capital loss, but an income gain. So you could potentially be taxed on income that you no longer have the value of, and you can't match off the loss.
Right.
So that is a big one. I've seen it in the last couple of years with crypto investors. Please be aware of that one because it's a terrible outcome. There's no tax relief on that capital loss that you make until you make a capital gain in the future. And that's uncertain. We never know when you're going to recoup that loss.
Yeah, thanks, Jono. Obviously, this is still a new, kind of makes sense, but obviously this is still a new space for us all. But I just wanted to ask you a question. So you mentioned investors would have their crypto or management of their gains and losses and look into that. So obviously they are probably using a crypto tax calculator or software to do that. Can you tell us how accurate that is? And if it's a big investor, should they seek out a professional to help them with that?
The software that's out there, I mean, everyone probably knows the names, Coinly, Crypto Tax Calculator. They're all pretty good. They bring in all the data so you can sync up. If it's on the blockchain, you can put in your public wallet address and it'll pull data from there. It's pretty good, but it's not perfect. So there are going to be instances where it's not going to treat the transaction correctly. They are getting better all the time, but what I've seen is if you're doing DeFi, staking, trading, NFTs, things like that, where there's lots of transactions, you might need some advice and some further work done on that software. It's like a business owner doing their own accounts, that can be good if they know what they're doing or they've trained in accounting or bookkeeping. But if you're not trained in that area, you may not be able to see some of the opportunities and some of the grey areas where there's benefits.
Yeah, it makes sense. So I guess to get an accurate reading of your tax position or your gain or loss position at year end, you should either be an expert in using that software or seek someone out to help you with that, especially if you're a big investor.
Yeah, I'd endorse that.
That's all we have time for today's episode. If you liked what you heard, please share this to your network. Otherwise, if you do have any questions about anything that we did discuss, please email us at podcast@solveaccounting.com.au. Until next time.
Thanks, Phil.
Thanks, Phil. Thanks, Jono.
Bloxy.
Thank you, fellas. Have a good day.
Well done. Let's have lunch.